fall in a generation. You really have to go back to 2009. And in some ways, it does feel like this is going back to the good old days for rainmakers on Wall Street. We've gone through a stretch, nearly a decade post-crisis, where after inviting a lot of scrutiny and anger from lawmakers, especially in the wake of the crisis, when the big banks went ahead and rewarded some of their top talent in 2009, a year after the federal bailouts, that forced them to put a lid on how much they were paying these people. And we also went through a period of what felt like a little bit of a secular decline, definitely in trading. All that changed with the pandemic. There are some echoes to what happened in the crisis, government intervention, market stabilized, unleashed sort of this wild trading activity, deal-making bonanza. In 2020, they showed some level of restraint. They were printing record revenues and profits, but they were willing to cap how much they were willing to pay people because A, they didn't know how long this would last, and B, the optics aren't really great to pay people top dollar in the middle of a pandemic. Move into 2021, the boom rumbled into a second straight year, but the conversation shifted to retaining talent, the war for talent, people getting fed up, tired, and wanting to switch seats, and frankly, much better opportunities elsewhere in the financial landscape. That has forced the big bosses at the major US bank to really open up their wallets.
So was this going to happen pandemic or no pandemic, or was it accelerated, exacerbated because of the fight for talent as some people maybe left the workforce and went elsewhere?
You would really struggle to make a case for this happening without a pandemic, because without a pandemic, there was no reason in the typical growth rate we've been seeing in trading and deal-making activities for banks to be able to print the kind of numbers that they did in 2021. Whether they accept it or not, there was certainly this government intervention that started in March 2020 that stabilized the market and then ensured that it absolutely zoomed ahead.
Right.
And there is a very real argument to make that without federal support through the absolute depth of the pandemic, it wouldn't have happened.
Can we talk about
the coach?
Go there.
We got to talk about the coach because you and Hannah Levitt, who's the co-author on this, got some incredible information about Goldman CEO's coach. What did you learn about a coaching session that they had to prepare for congressional testimony?
Just to give our listeners a sense of what we're talking about, we do point out that not so long after David Solomon rose to the top rank, became CEO at Goldman Sachs, he was preparing for a congressional hearing. And there is a process that's known as murder boarding, where effectively executives at the firm will throw all sorts of questions at the top executive to try and give them a sense of what they can expect from lawmakers at the real deal. One of the questions posed to David Solomon was, would you be open to paying higher taxes if it went towards spending on social services? At first he fumed. He thought it wasn't the smartest question. But then the coach said, you know, Jamie Dimon has been awfully public about this idea that he would willingly do it. To which we understand Solomon said, of course, Jamie can say that because he's made all his money. Why that is interesting is that it offers a little window into the mindset. David Solomon is among the class of newly climbing executives. He's reached the top spot at Goldman Sachs in a very different era than when Jamie Dimon ascended to the top. And we talk about this new generation, this generation that's at the top right now. They have missed out on the riches reaped by executives and leaders who came much before them. And that shows in the numbers. Jamie Dimon is a billionaire 2 times over, and David Solomon is not close to that. No one is saying that David Solomon is not rich, quote unquote, but there still is a difference.
It's a sign of the times. Go to Bloomberg.com and read the story. We'll put it out on Twitter. Sri Dhanarajan, thank you so much. Finance reporter at Bloomberg News.
Now to Nancy Lyons in Washington, D.C. for an update on news. Hey, Nance.
Thanks, Tim. The U.S. is sending more troops to Europe as Russia continues its military buildup along Ukraine's borders. Pentagon spokesman John Kirby.
The current situation demands that we reinforce the deterrent and defensive posture on NATO's eastern flank.
1,000 U.S. troops will move from Germany to Romania. 2,000 others will be deployed from here in the U.S. to Poland and Germany. This is in addition to the 8,500 troops already on heightened alert. Senate Minority Leader Mitch McConnell says the Biden administration needs to do more to boost Ukraine's defenses. He says we need to cut through the red tape and send supplies now.
This help needs to arrive before a Russian escalation. so our friends can defend themselves and prepare for what could be a cold and bloody winter.
McConnell says there's no substitute for hard power, something he says the U.S. must use against Vladimir Putin. For the second time in less than a week, police officers have been mourning the loss of a police officer, Wilbert Mora. They've held a memorial service today at St. Patrick's Cathedral. Mora and his partner, Jason Rivera, were shot and killed as they responded to a domestic disturbance call. A service for Rivera was held last week. New leadership is coming to CNN after the network's president, Jeff Zucker, stepped down today. He says he did not disclose a relationship with a longtime colleague. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
Hey, Nance. Thank you so much. Nancy Lyons in our DC studio. This is a funny story.
There's been a lot of back and forth between, well, more so online, what I see when it comes to the way that Tesla has been sort of snubbed from the White House.
Yeah, well, here, let's lay it out for you. Ardana Hull and Jennifer Jacobs of Bloomberg laying it out. President Biden calling himself a union guy and a car guy. He's embraced electric vehicles as vital, to his economic and climate ambitions. But there's one U.S. car company he will not talk about. That's Tesla.
Yeah, pretty big U.S. car company. It's the world's most valuable automaker. It's also, of course, the global brand most clearly associated with EVs. Carol, it's something that you refer to a lot when you see the big investments that Ford and GM are making. A lot of that has to do with what Elon Musk has done at Tesla and catching up to Tesla. President Biden tweeted a video with General Motors chair and CEO Mary Barra on Thursday saying, quote, "I meant it when I said the future was going to be made right here in America. Companies like GM and Ford are building more electric vehicles here at home than ever before."
And the tweet
is building electric vehicles in the U.S.
Who started the push? Tweet didn't go unobserved by a Twitter user, someone who is on Twitter a lot. And of course, we're talking about Tesla CEO Elon Musk. He did put out a tweet. And here's the quote: "Starts with a T, ends with an A, ESL in the middle." He replied. I was just looking for the tweet to find it on my feed because I do track him pretty regularly. It's funny because every time the president has a chance to really talk about it, he does often talk about the progress Ford is making, that GM is making, moving towards an electric fleet.
Well, there's a reason why, as Jennifer writes in this story along with Dana Hull. There's no real mystery behind Biden's antipathy toward Tesla, according to a person familiar with the president's thinking. The president has long enjoyed the support of unions in his political campaigns, including the UAW. And while Tesla employees enjoy generous pay and benefits, including equity, Musk is hostile toward unions and company workers aren't organized. Politics.
Everywhere. Hashtag politics. All right, you're listening to Bloomberg Business Week. Carol Master, Tim Stanovic, and you are listening to Bloomberg Radio.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Groundhog Day, stocks up again. U.S. stocks on track for their biggest four-day rally since November of 2020. Dip buying in battered tech shares has resumed. We've got NASDAQ up now by 63 points, up by 0.4%. NASDAQ 100 index up 0.7%. S&P 500 index, best level of the day, up 40 points now, up 0.9. The Dow's up 213, up by 0.6%. Spot gold up 0.4, 18.08 the ounce. West Texas Intermediate crude right now is trading lower by 3 cents, 88.17 a barrel. 10-year yield 1.76%. Bitcoin dropping 3% now, 37,634 on Bitcoin. After the closing bell today, among the companies scheduled to report earnings, Meta Platforms Inc., formerly known as Facebook, shares up by 1.4%. Qualcomm also reporting after the close of trading today. Qualcomm shares up now by 5.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Meta, Facebook, where are you going with this one?
I'm still thinking it's Facebook.
Charlie, you still Facebook? No, we lost
I'm still struggling with both Alphabet and Google. So.
I know. Come on, companies, don't make it so hard.
You're still calling Kraft Philip Morris. Terrible.
And rightfully so.
I'm just kidding.
It's all going back and forth anyway.
Hey, and yesterday, CSX, I called that Chessie System, so what can I tell you?
We've been doing this for a while.
All right, well, in the new issue of Bloomberg Business Week, out in its entirety tomorrow, online on the Bloomberg and on newsstands, a story about the investors who have been backing Cathie Wood and her ARC's array of ETFs. They're sticking with her even as her flagship fund has plummeted big time, Tim.
They are what the headline refers to as true believers. Joel Weber is editor at Bloomberg Business. He joins us on the Access line from Brooklyn. The story written by Sam Potter, among others. Sam is senior editor and ETF czar at Bloomberg News. Check out this story. It'll be featured in the upcoming issue of Business Week magazine. Also, you can read it now at Bloomberg and on the Bloomberg terminal. I tweeted it out earlier today. Joel, what's happened with Cathie Wood's fund, we know we've covered the performance closely. Our audience is familiar with it. But something really interesting has happened. Investors are sticking with her.
That's right. So it's an interesting phenomenon when from peak, I think it's down something like 40%, while S&P is up 20%. You would think most fund managers who endured something like that, something like a 60 percentage point spread, would see outflows. And yet that's not entirely the case with Wood. It's proving to be really sticky assets. And why do we think that to be true, Sam?
Yeah, hi. Good afternoon, everyone. I mean, the fact is that Cathie Wood has really sold a story, a narrative of the future that her investors certainly appear to really be on board with and to believe in. I mean, to give some figures to what we're talking about here, the main fund, the ARC Innovation Fund, is down about 20% so far this year. It's actually got positive flows, so it's got net inflows for this year while it's fallen 20%. The reasons are, our BI guys like to do a lot of analysis on this, and they talk about how most investors these days are heavily invested into big index funds, big, boring, market-following funds. And then what they do is, with a little slice of their investment, they take a risk, they take a gamble, they want to put it on meme stocks or on crypto. And ARC seems to fall into this kind of bracket. They call it the hot sauce. So people are prepared to put their money in and leave it in. And even with these heavy losses, they're still kind of shrugging and saying, you know what, I think this might come good. And even if it doesn't, I'm along for the ride.
Well, and what's interesting, too, as you point out, Sam, in your story, is that a lot of these people who've gotten in, a lot of them, right, have gotten in at the peak. So, I mean, if you were there from the get-go when she started out in 2014, the inception of all of this, you made a lot of money. But if you got in at the highs, you're hurting.
Yeah, it's a classic story of sentiment, isn't it? The bulk of the money came in just as the ARC story really peaked. We're talking early last year. So when you actually calculate the volume of cash coming in by the price that was paid at the time. I mean, it's an estimate, but you're looking at being underwater by about 20%, maybe 25% sometimes in the main fund, for example. So the majority of cash that's come in is arguably now reduced. But again, we've seen star managers before, and history tells us the tale, and it all unwinds when investors have had enough and walked away. Mm-hmm. At one point, the ARC Innovation Fund was down about 60% from its peak. Right. And yet, we have inflows this year. It's an incredible story of faith.
Buy low, sell high? Isn't that what we're supposed to do?
So another thing that kind of stands out to me, or that I'm curious about, Sam, is, you mentioned the innovation fund there, flagship ARKK, but she has other ETFs that all have, their own spin on things. How sticky are the assets in those funds compared to the flagship one?
It is true that they are not proving as durable. We see, it's a mixed picture across the funds, but we do see that proportional to the assets, the outflows have been higher, and the performance of a number of those funds is similar to ARC Innovation. So it isn't, it isn't a universal thing, and it's going to be really interesting to see how some of those funds, especially the ones she launched sort of quite late on, the Space Fund, the Transparency Fund. It'll be interesting to see how those fare. I'm reasonably confident this ARC Innovation Fund is around for the long haul, but whether and how well the others survive remains to be seen.
Hey, just real quick, Sam, I'm wondering specifically about the idea of her social media following, and it's interesting in here. I didn't know that she had more followers than the biggest ETF issuers combined right now.
Yeah, that's right. She's got more than 1 million followers herself, and then her analysts, and it's not a very big team at ARC. I think the whole firm is about 45 people. They've collectively got another 500,000. So taken together is more than State Street, BlackRock, and Vanguard's official Twitter handles combined. And that sort of speaks to her breadth and her popularity. And one of the ARC portfolio managers is in the story and saying, one of the things that people like about us and why we have these fans is because we're very transparent. And they do, to their credit, they do, Cathy Wood is often online. She tweets her research, their thinking. They are very engaged. And as we've had a sort of retail investor boom, I think that's really played into their hands.
Well, it's fascinating. You really get into the details as she's drawn in money, how she's had to maybe lay out to some different bets and those names that maybe don't trade as actively. We got to run. Sam, thank you so much. Sam Potter, Senior Editor and ETF SAR, Bloomberg News from London. Jill Weber, Editor of Bloomberg Business Week. This story in the upcoming new issue of Business Week magazine.
I also tweeted it out, so you can see that on my Twitter feed as well.
You're tweeting a lot today.
I am tweeting a lot. I love the stories. I'm starting to tweet again. Well, February is Black History Month, and every day this month we're celebrating significant moments in U.S. history. Now with your installment for February 2nd, here's Bloomberg's Renita Young.
On this day in Black history in 2009, Eric Holder became the first Black Attorney General of the United States of America. He was confirmed as the 82nd Attorney General of the nation. Then President Barack Obama nominated Holder months before, and he served more than 6 years as Obama's Attorney General. This made him the third longest serving Attorney General in U.S. history. Today, Holder advises clients on complex investigations and litigation matters at international law firm Covington and Burling. That's Today in Black History. I'm Renita Young, Bloomberg Radio.
A big thank you to Bloomberg's Renita Young for that update.
Quick check on the markets for you, everyone. We've got the S&P 500 hovering near its best levels, up 39. Dow up 201 points, up for a gain of about 0.6%. NASDAQ just up about 58. We're going to head over to our TV team to talk about the markets in a moment.
to the Close, Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. Just 60 minutes left in your trading session. Caroline Hyde, Romaine Bostick, Taylor Riggs, joined now by our colleagues Carol Massa, Tim Stenovic, as we go cross-platform TV, radio, YouTube. No Groundhog Day here for us. Instead, we're looking at a market that is, 4 days to the higher, the best run since November 2020.
Yeah, absolutely. Fun.
Isn't that the definition of Groundhog Day? I mean, it's like what happened yesterday.
Same thing as yesterday.
The day before.
And the day before that.
Okay, wiggle
Deja vu all over again, right? I've been watching the energy sector. Certainly, we heard from OPEC a modest increase. Energy, one of the laggards in today's section, but session. Help me, Groundhog. But what's interesting, if you look year to date, energy is obviously your top performer, and the 10 top performing names in the S&P 500 are all energy guys. Halliburton's up about 37%.
Did you, Carol? Did you hear about Milltown Mel, the groundhog out there in New Jersey, who apparently passed away the day before Groundhog Day?
That's really rough.
You had to go there.
That's really rough.
Okay, well, Puxatani, Phil, is still alive.
He's doing well.
Okay. I think.
Alive and kicking.
Or his offspring.
More wind.
Which state's he in?
That's Pennsylvania.
We're going to just talk
You've
about
never been to Puxatani?
It's because you have a new puppy.
Yeah.
This is why we're going into pets.
I once drove up to Puxatani just because I was curious. Yeah.
That is the reporter. That is the reporter in you, Romaine.
His puppy had his coming out. Or her
Should we do the
coming out,
markets?
I
I don't want to. I want to stick on puppies.
Focus.
It's just he's underslept.
The people demand it.
He's up every hour. But meanwhile, we're seeing S&P 500 up 0.8%, 35 points higher, 4,582. Dow Jones up 0.5%. We're seeing a 192-point gain on that particular index. NASDAQ up 0.3% as we get Alphabet and the likes doing well after their earnings yesterday. Got more lined up. Russell 2000 on the downside. Small caps not getting much love today.
Take a look at the sectors. When Romaine talks about breadth, at least from a sector perspective, things look a lot better than yesterday when it was mostly about half and half. Look, it's communications. We know that from some of the big tech companies. It does feel a little defensive. Real estate, healthcare, utilities, those are typically the bond proxies. But pretty much the top half of that screen is all up over 1%. The only thing at the bottom, Romaine, is consumer discretionary. That's off 0.8%.
Yeah, and I mean, look, you take a look at the big movers. Obviously, Google is really driving this. Alphabet, whatever we're going to call it these days, up 8%. Was actually up about 10% here on the day, above 3,000. Of course, they are splitting the stock. But believe it or not, the other big movers out there today is not just, basically Alphabet. You got AMD up about 5% here on the day. Qualcomm, whose earnings we're going to get after the bell, they're up about 6% here on the day. But the big drags that we're taking a look at here, PayPal is the biggest decliner in the S&P 500. Right now, you talk about some of that total payment volume still rising, up 23%, but well below those pandemic levels. And now a lot of talk right now about whether some of the pandemic boom that some of these companies like PayPal had, whether that can continue. And Dynatrace, not a stock we talk a lot about much, those shares down 19% today. The infrastructure software company in a similar situation as PayPal with regards to some of that pandemic era growth really starting to moderate back down to pre-pandemic levels.
Meanwhile, I mean, I think what's so fascinating about you reference Alphabet, keeping it down with the kicks with the Google as well. But I'm looking at what happens when you get a stock split. All important as we look at second on your screen, Amazon comes out tomorrow in terms of its earnings. The amount of Twitter traction I saw about whether or not Amazon will be the next one to announce some sort of stock split, because they're $3,000 per share. We know that the fundamentals don't change of a business when you split yourself, but potentially psychologically you're more willing to buy into it.
And you got a chart now on screen for our radio audiences. I mean, there's only a handful of stocks in the S&P 500 that are actually above $1,000 a share. NVR, Amazon Booking, AutoZone, Chipotle, and you talk about some of these names. And I guess the question is, do you really need to split a stock?
No, you don't need to split a stock. I have a real bone to pick with the idea of this being accessible. Look, for years, investors have been able to buy fractional shares of stocks. Right? You do it through slices at Schwab. You can do it in Robinhood. You can do it in E-Trade. So it's just it doesn't matter. It matters for index inclusion if you are considering the Dow. It matters for that.
It's a very serious question, though. When people see a $3,000 price tag on a stock, does that somehow deter them from buying it?
No.
They can buy $200 of that stock if they buy a fraction of the stock.
Okay, but Romaine, you do sort of shut us down every time we talk about the Dow, and the point is taken. And to Tim's point, we talk about the S&P. But if you are thinking of a more of an equal weight instead of a market weight, maybe that's to help spread out some of the weightiness of that.
And there comes index tracking. More money to be pushed into the Dow if indeed Alphabet does indeed join it. That would help from a price point perspective. Most companies do rally after they do a stock split. Make of it what you will. But what's also notable is that we keep on getting companies that are priced higher on an individual stock basis. You've now got 27 companies that cost you more than $500 a share.
Just going to say Berkshire doesn't seem to care. So I'm just going to put that out there. Hey, we're talking earnings. We're talking stock splits. We're also talking economic data. We got a reading on private jobs, and we did see it plunging in the month of January. Big time economic data. It's tough to read. Do we ignore all of the January data because of Omicron? Our Balance of Power team, David Weston, catching up with Nathan Sheets over at Citigroup.
Oh, I like him. Yeah, he's good.
Yeah, he is good. Okay, so then let's hear from him and what he had to say about economic data.
It is really sloshy out there right now, and there is, as you say, a lot of uncertainty about where the economy is. And I think we'll see that on Friday with these job numbers. They're going to look weak. There were people who couldn't work during that key week of January because of the virus. And it really does complicate the Federal Reserve's challenge.
All right, that's Nathan Sheets. He's Citigroup Chief Global Economist. What's interesting, too, then, do we wait, guys, for a month until we start to get data that is past the Omicron variant? Because keep in mind that monthly jobs report, it's the first half of the month, and that's when the virus was raging.
Yeah, and this is where we're going to start on Friday. We're going to be talking a lot about distortions and sort of what that means, and I'm sure Michael McKee and the other experts we have on staff here will be able to explain it way better than we can. But I do wonder if that becomes sort of the excuse of, well, this is some distortions. It doesn't really knock the Fed off course.
Is it an excuse or reality that these are data points that are skewed? I mean, there's seasonal variations, there's also revisions and stuff. So do we, smartly so, have to kind of look through it until we get some data?
Well, you can look through it, or maybe you just split it 20 for 1, and then it becomes more important.
Yeah, it's all about the eye of the beholder. The eye of the beholder has been trying to front run this. We've had, of course, the administration, Marty Walsh, earlier this week, really trying to signal that the numbers aren't going to look as pleasant, aren't going to look as appetizing when you look at the jobs numbers come at the end of the week. But as we know, we've seen the market rally since all 6 of the Fed speak that we've heard so far this week have not liked the sound of 2 rate hikes as soon as March. They've been dialing back from that. And maybe it's because some of this labor data is, to use Nathan Sheets' terms, squashy.
Mary Daly of the San Francisco Fed, right, saying gradual rate hikes won't derail the economy. So we continue to see this management, Tim. Oops.
I wonder if they're pushing for 50 so that when we do less than 50, our expectations have been lowered, right?
They're playing with the market, I feel like, right now.
Chopping it into 20.
Seeing how the market manages it. All right, we're going to continue this conversation, no doubt about it. We'll be back with Beyond the Bell on radio, TV, and YouTube. We're going to count you down to the market close on this Wednesday.
You're listening to Bloomberg Business Week with Carol Messer and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Man, it's like a crazy Thanksgiving dinner. At,
I know. Well, I'll tell you what I was going to say, okay, if you're interested. So we're talking.
You're what is it? Hackles? Like about the stock splits?
I think it was who said squashy? Was that Nathan Sheets?
Nathan Sheets.
Described it as squashy,
about
right?
Economic data.
What
were you going to say?
Well, look at the range that we're seeing about in terms of the estimates for the numbers that we see on Friday. The low estimate, negative 400,000 jobs. Okay, the high estimate, 250,000.
So
that range there,
that
range there is just massive and shows the uncertainty around this report.
I think just it's hard to read, and I do think, and I feel like I've been, saying the same thing over and over again. But until we get through, you pull back on the stimulus, everything that was given to the economy, individuals to get through the pandemic, until you get through those economic data points and the rises in some of the variants, I don't think you get a really true picture of what's going on. We talked about GDP, inventory build. So what does that take away from future growth? It's hard. Is the demand going to be there in the future? There's so many questions.
And look, it's an important report. It's a monthly report. It's one that we put a lot of stock in, and it's just one of many pieces of data and parts of economic reporting that the Fed uses to make decisions.
#nimble.
Nimble, exactly.
It's why the Fed uses words like that and doesn't commit in terms of specifics and has been kind of spoon-feeding us information. You know, we now expect something to happen in March in terms of some kind of interest rate move, but there's a lot of debate about how much, and then there's a lot of questions still out there. All right, let's get back to world and national news. A lot going on. Nancy Lyons covering it. She's in our 99.1 newsroom in Washington, D.C. Nance.
Thanks, Carol. President Biden is sending more American troops abroad to Eastern Europe. The Pentagon's John Kirby says they'll begin with moving 1,000 troops from Romania to Germany and sending a 2,000-troop task force from the U.S. to Europe.
This force is trained and equipped for a variety of missions to deter aggression and to reassure and to defend our allies.
Kirby says the moves are just temporary. President Biden says he's making the fight to cure cancer a presidential priority. He's outlining plans to tackle the illness, including appointing a cancer cabinet and a new agency to tackle cancer and other diseases. He hopes this is a bipartisan effort.
We can do this. I promise you, we can do this. For all those we lost, for all those we miss, we can end cancer as we know it.
Biden says his goal is to cut the U.S. cancer death rate by half. One NFC East team has officially unveiled a new name. Bloomberg's Amy Morris has more from Washington.
After years of controversy over its old name, the Washington football team is now officially the Washington Commanders. Team president Jason Wright made the announcement on the Today Show.
It's something that can allow us to tie the rich history and championship legacy of this franchise to new traditions in the future.
The franchise dropped its old name and logo 2 years ago, playing the past 2 seasons as the Washington football team. Now they're looking for fan input to come up with a new team song and mascot. In Washington, I'm Amy Morris, Bloomberg Radio.
Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. So this was a story that crossed the Bloomberg terminal in the morning. As a headline, and then it was kind of reported out. It's among our most read stories on the Bloomberg. It has to do with Melinda French Gates.
Yeah, she's increasingly giving away her fortune through philanthropies other than the $50 billion Gates Foundation. Remember, she's formerly Bill and Melinda Gates. Now she goes by French Gates. She now intends to spread her wealth across philanthropic endeavors rather than pledging to give the bulk of it to the Gates Foundation, Dow Jones reported, citing people familiar with the matter.
Yeah, she and her former husband, Bill Gates, described their individual plans for donating their fortunes in letters posted online. That you might recall from November. I know we talked about it. Almost 7 months after announcing their divorce, she then has been building up her own philanthropic investment firm Pivotal Ventures, which she started in 2015 with a focus on implementing, quote, innovative solutions to problems affecting U.S. women and families. She is worth $11.4 billion, according to the Bloomberg Billionaires Index. Gates has the world's 4th highest net worth at $130 billion. So it sounds like taking charge of the money that is hers and deciding where she wants to allocate it. We saw that certainly with Jeff Bezos' former wife.
Exactly. That's exactly where I was going to go. Mackenzie Scott, Jeff Bezos' former wife, she's become one of the biggest philanthropists in history in just a few months following her 2019 divorce from Jeff Bezos. Mackenzie Scott is the world's 26th richest person, according to the Bloomberg Billionaires Index. She's got a net worth of $50.9 billion. She's also worked with Melinda French Gates as well.
Yeah, that's interesting, right? And it's funny because if you hear about the former wife of Jeff Bezos, she really does it in different ways. And there have been stories about that she just throws some money here and there, and people are like, "Wait, who is this from?" Like it comes very quietly.
Yeah, it's really shaken up philanthropy over the last couple of years.
The bulk of the Gates' money, though, by the way, is still going to the foundation. So just FYI, since they're split, they've jointly announced $2.1 billion for gender equality, $900 million for nutrition, and $150 million to the Coalition for Epidemic Preparedness Innovations. All right, you're listening to Bloomberg Business Week. That is among the most read on the Bloomberg terminal. This is Bloomberg Radio.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
Bloomberg World Headquarters, I'm Charlie Pellet. Tech earnings front and center. The Dow, the S&P, NASDAQ all advancing. 43 minutes to go ahead of the closing bell. Let's head right over to the first word breaking news desk for today's afternoon call. Here he is, Bill Maloney.
And good afternoon, Charlie. U.S. stocks trading higher today, helped by that 8% gain in Alphabet. Dow's currently up 220 points. S&P's gained 41, while the NASDAQ is higher by 68. The U.S. 10-year yield at 1.77%. Gold is up 6. Oil is little changed. And Bitcoin is down by 3.1%. Among the main 11 S&P sectors, only consumer discretionary was in the red. And leaders to the upside in the Dow, UNH Travelers and Procter & Gamble, while Salesforce and Disney led to the downside. After earnings, PayPal plunged 25%, C.H. Robinson fell 11%, and AMD rose by 5%. In geopolitics, Biden approved new U.S. deployments to Eastern Europe. And wrapping things up, it's another busy night for earnings with Facebook, Qualcomm, and Spotify all reporting after the bell. Live from the first breaking news desk, I'm Bill Maloney. Charlie?
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg type squawk, SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
So we've been talking about what's the best credit card to get with our Jenny Serang.
Yeah, that's because
she tracks this stuff.
Yeah, she covers fintech, she covers credit cards, and we have her in the studio for the first time in a while, so we got to be like, Jenny, what is the credit card that we should have right now? How do we get the points? She should start a blog.
She really should. She's the points guy. She's our own version of the points guy. Meantime, we do want to talk about PayPal because, man, it's getting whacked today. Right now, it's down about 25%. Certainly, I think the top decliner in the NASDAQ 100. Let's get to it because apparently the company is getting stung by bad actors.
Jenny Serang is finance reporter for Bloomberg News. She's with us in the Bloomberg Interactive Broker. She wrote about these bad actors. PayPal, as a result, shutting 4.5 million accounts. Among other reasons, the company taking a hit in the trade today. What are bad actors?
So last year, for the first time really ever, PayPal started to do what we've seen a lot of other fintechs do, which is say, if you sign up for a new account, we'll give you $10, and really going hard after those new users. And basically what they got hit with was a bunch of fraudsters using bot farms, opening a bunch of accounts fraudulently and not intending to be legitimate customers at all. And so after this big review, they go through, they decide, okay, we're going to close those that we know are a problem, and they're actually going to stop doing that type of marketing in general. So they have said, we're no longer going to shoot for just growth in new users. We're really going to try and focus on our existing users and get them to use us more.
Not about quantity, but quality.
That's what they're saying.
But I mean, this is an important metric, right, for how we measure the success of PayPal. And that's why this is dragging down, or in part really, dragging down the share price today.
Yeah, so yesterday it was really interesting to hear the executives on the earnings call talk about, we're not like a subscription business. We're not like a Netflix where every new user automatically yields $15 a month in revenue. So they really do depend on their existing users using them a lot. And we did see a little bit of that improve in the quarter. I think folks are using them. It's usually around 45 to 50 times on average. And so that's a month?
Quarter?
Yeah, a
quarter,
exactly. And so, and that's going up. And so that's what they want to see. And so they're just saying, instead of putting our marketing dollars around, getting to our first billion users or whatever, they're really focused on just making sure that the 500 or so million that they have are using them a lot.
You know what's crazy? In Max Chafkin's book about Peter Thiel, when they talk about the origins of PayPal, this was an issue when PayPal first started. Back in 20 years ago. And they're still battling it out today.
Yeah. What's old is new again. That's very, very true. I mean, it was kind of a perfect storm for PayPal. They're dealing with a lot right now. Their former parent company, eBay, has announced that they, are moving, they're going their separate ways. So that's happening to them. In general, e-com didn't do as well as folks thought it would during the holiday season. That's obviously PayPal's bread and butter. So they're just dealing with a lot of different headwinds right now.
Is there also just a lot more competition out there? Or tell me, what is PayPal's, future place in our financial world?
They are really aiming to be honestly the next like Ant Financial or the next WeChat. The things that we've seen over in China that have done really well is like a super app. So they want to be your one-stop shop for all things.
I want to be
finance,
Wonder
all
Woman
things-
too, but
yeah.
you know, here I am.
The thing is, they've really dominated an online checkout. So that little button that you see when you're ready to go check out online, PayPal is buying away the biggest player there, and they have secured and established and fought off any other potential upstart there. So they're ready to do more, and I think this will be a big test as to whether or not adding all these new services like crypto trading or coupons or shopping, does that really work? Is that what consumers think of when they think of PayPal?
Well, Jenny, because they have had so much success when it comes to checkout, I'm wondering what exactly that product is and how it benefits the company. Because isn't it just using your PayPal account to pay for whatever you're buying? And the PayPal account is linked to a debit card.
Yes. So they take a little bit of a percentage, the merchants. Every time you check out using PayPal, they take a little bit of a percentage from the merchants. And that take rate, it actually didn't decline last quarter, which they were celebrating it. The take rate that they get per transaction had been on the decline for a few quarters in a row. So that's looking a little bit better, but I think they realize that is not, the kind of growth story that everyone's excited about, and really not the growth story that they sold during much of the pandemic when e-commerce was going crazy and folks were turning to them left and right and volumes were through the roof. So they're really definitely focused on this super app strategy, but it's early days, and I don't think that they've convinced everyone that, that's the future.
It's a massive company, $155 billion market cap. I was kind of surprised. Like,
well,
yesterday
it was a lot bigger.
Yeah, it was a lot bigger. But I do wonder, like, does it make sense for them to ultimately link up with someone, an established, more traditional financial company? Is that a good way of kind of melding? I don't know.
I think, so last year, there was lots of talk of them linking up with Pinterest, which was kind of an interesting.
Yeah, that's not what I was thinking about.
Yeah, but I think that's really more what they're thinking. I don't think that they want to go the route of linking up with a bank, but it could make sense. I think they're a very interesting player in the sense that they are a fintech, they're a tech giant, but they're firmly in financial space. They have really good relationships with regulators. They know how to navigate the intricacies of being a big behemoth in finance and payments. So we'll see. We'll see what they end up
Do
doing.
they, just very briefly, they don't have a bank charter, right?
No.
And do they work with other banks, or do they, like other fintechs?
For lots of different products, they have bank partners and all sorts of different processing partners, but they are not a bank.
And I know it's not apples to apples, but it's not a UBS Wealthfront kind of thing. Like, you don't see something. I just feel like there's so much movement right now.
There could be.
In the space.
They're just such an
Again.
unusual player, and they're giant. I mean, to your point, I don't see a bank shelling out $200 billion, $300 billion for PayPal right now.
Yeah. All right. To be continued, as we like to say. Jenny Serrain, we always have a great time when she's in our studio or just we're chatting with her. She's finance reporter at Bloomberg News here in our Interactive Brokers studio. Check her out on Twitter at Jenny Serrain. This is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
Coming up, we've got a conversation with Brown University President Christina Paxson.
But first, a check of the markets. Here's Charlie Pellet.
Very much. We are higher across the board with the Dow, the S&P, NASDAQ, all at or near session highs. Right to the numbers. 28 minutes to go. The S&P up 41, up by 0.9%. Dow Jones Industrial Average up 225, up by 0.6. NASDAQ up 63. That is a gain right now of just about 0.4%. 10 years up 3/30 seconds. 10-year yield 1.77%. Spot gold now higher by 0.3%. 18.06 the ounce. Bitcoin down 3.3%, 37,524, and West Texas Intermediate crude oil up right now by 0.1%, 88.31 a barrel. Stocks on track for their biggest four-day rally since November 2020. Dip buying in battered tech shares has resumed today. Among some of those names, we've got shares of Alphabet up now by 7.8%. Alphabet reporting earnings last night after the bell. Today we will be hearing from Meta Platforms Inc. up by 1.4%. Also reporting after the closing bell, Qualcomm up now by just about 6.1%. Again, recapping, stocks move higher. S&P up 41, a gain of 0.9%. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. You're listening to Bloomberg Business Week. We'll be breaking those earnings after the close. Right now, we want to welcome our Bay State business team, Joe Shirtsleeve and Tom Maroney from Boston, in conversation with Brown University
I'd like
President.
to welcome our Bloomberg Business Week audience. Thank you, Carol and Tim. I'm Tom Maroney with Joe Shirtsleeve. And as I've been saying to our Boston audience, we'd like to bring in our special guest now. She is the president of Brown University, Christina Paxson. Madam President, welcome. And I say that once because I understand you like to be addressed as Chris, so we'll dispense with Madam President if that's okay with you.
That is fine with me. Thank you very much. I'm glad to be here.
I am just, we want to tell people a little bit about your background. You're the 19th president, also a professor of economics and public policy. And our Bloomberg audience very interested in the idea that you're also the chairman of the board of directors for the Federal Reserve Bank here in Boston. So, again, welcome. I've been looking at your calendar, and I want to start with the school, of course. There's a winter session that goes on till February 9th, according to the calendar I'm looking at. Then your spring session begins February 17th. So you do have activity there, but let's talk about the spring semester and what you've done in the face of this pandemic to ensure safety and that sort of thing.
You know, you may be looking at a different calendar, an old one. We actually started classes a week ago Wednesday for the spring semester.
I apologize.
That's okay.
Yeah.
So we had a online winter session, which is normal. That wasn't a COVID thing. But now students are back and they're taking their classes, and it's great to see them.
Chris Paxson is our guest. She's the president of Brown University. Okay, so what has been the pandemic impact on higher education? Has it been, forever altered, forever changed? And I ask that, as I think about this whole idea of, virtual or remote education versus in classroom education. Your thoughts?
Mm-hmm. So I think we've learned two things through the pandemic. One is that we can teach very well remotely. And, if you'd asked our faculty 2 years ago if they thought they could do that or they wanted to do that, they would have said no. And they did it. And, for Brown, it was only for a brief period. We've been back in person for a long time. The other thing we've learned is that our students want to be together, and they do not want to sit at home with their parents going to college. So it's been interesting. So, how has higher ed changed? We're such a diverse sector. The impact on community colleges or big publics or privates, it's going to be very different. We're looking at incorporating a lot more remote online components into our education where it actually can improve the quality of what we do and expand the reach. More on the graduate school side than the undergraduate program, but I think there's some really interesting things we can do with undergraduates as well.
Chris, everybody is always talking about the cost of higher education, and I'm sure you're as concerned as anyone else. And, there's competition out there, even though you are an Ivy. I mean, what are you doing as the president of Brown in that regard? I mean, what kinds of things can you do to ensure that you're going to have a steady and robust flow of applicants?
Mm-hmm. Well, we have over 50,000 applicants this year for a class of about 1,700 students. So we're
in pretty good shape.
Yeah, we're fortunate. We're fortunate. Not all schools have that luxury, and I really recognize that, and it's important. But I would say, our focus has been on making sure that Brown is affordable for all the students we accept, and that we accept them without regard to their financial need, whether they need financial aid or not, and how much they might need. Right now, if a student's family earns under $60,000 a year and has typical assets for that level, Brown is free. Under $125,000, tuition is free. So, for the vast majority of people in this country, the incomes are not that high, and so it can be less expensive to go to a college like Brown or like some of our peers that have generous financial aid than to go to a state university. And a lot of people don't recognize that.
Talking with Chris Paxson. She's the president of Brown University. And I don't know if you heard me, but as we were introducing you, I was saying that, I went to Holy Cross. So did my 4 brothers. So did 2 of my 3 children. So this whole idea, of a legacy, a leg up when it comes to admission works for me. But it has been controversial as of late, and about a lot of questions raised about it. I understand that you are in favor of legacy as, an element of admission. How come?
Well, I think whether a student applicant's parents, one or both parents, went to Brown should be one of many, many factors that we look at when we decide admissions. And frankly, not a very important factor, but it's in the mix. So, and nobody gets accepted unless they're really, really qualified to come. And again, we have the luxury of having so many great applicants. We could fill our classes several times over with really qualified people. I think that on the margin, if I have a choice between 2 very, very similar applicants, one of whom has a parent who went to Brown and another one who has a parent who went to another very fine institution in the Northeast, take your pick, I'll go with the student who went to Brown because I think it helps build community, and it's also a competitive advantage. I mean, the students whose parents went to Brown, on average, are very well qualified to come, and that's a good thing.
We are with Chris Paxson, the president of the Brown University. We want to talk about your role as chairman of the board of directors of the Federal Reserve Bank very quickly here in Boston. Who will succeed Eric Rosengren?
I cannot tell you that. We're still in the middle of the search.
Yeah. He was such a passionate champion of housing and that sort of thing. Is that going to be in the mix as you folks decide?
Well, look, every president is going to bring their own special areas of emphasis, a different skill set. I was a very huge fan of Eric Rosengren's. I thought he did a fantastic job. And we will find a next fantastic president for the Boston Fed. They won't be exactly like Eric, but that's okay. So news should be coming out at some point, but I can't tell you exactly when.
Well, can you tell us just a little bit about the process that is ongoing right now that'll lead to that news coming out at some point?
Well, we tried to, and I think we did successfully, run a process where we spent a lot of time getting input from many, many stakeholders, a lot of community engagement, a lot of discussion with people in the New England area, and really wanted to get a sense of what's important to people for this position, because this position plays many different roles. It represents the New England district, the first district at the FOMC table, but it also plays a really important convening role in New England. so we wanted to hear what people thought. And I think we did. And I think that we built, have built a great pool. And the search will be done when it's done.
Chris, one of your many hats, you are professor of economics and public policy. That's still true, correct?
Yes, it is.
Yeah. So yesterday we talked about the New England economy, and one of our senior editors, Chris Anstey, who put this ed board together for us today, did some reporting on the healthcare and education sector, and that we're so top heavy with that kind of work here that it's going to take us a while, maybe more than the national scene, to catch up. What are some of your thoughts as we look ahead and hopefully we're getting out of this pandemic on the New England economy? What some of the things you think about are the highlights?
Well, the New England economy is really diverse. I think people who live in the vicinity of Boston tend to think of it in a very Boston-centric way, but we range from rural areas to agricultural areas to high tech. So again, that diversity is a really good thing because I think it keeps us strong overall. We're not too overbalanced in one area or another. Maybe I'm biased, but I think the kind of thing that universities do, which is spur innovation and attract businesses because of the talent that they produce, this all bodes well for the future of the New England economy.
Chris Paxson is our guest, and Joe Shortleff here, and this is my final question to you. It has to do with the international students, something we all learned about universities during this pandemic, how critically important they are to, the financial backbone of our universities. What is the future for international students? And you can talk about it from Brown's point of view, but specifically we're wondering about, Chinese students because China is imposing new restrictions.
Yeah, I think having a flow of students across country borders is so important, and I would hate to see artificial restrictions on students from any country coming to the U.S. And it's a source of talent for our own economic development. It drives growth. So I'm a big fan of building in that area and resisting anything that's going to limit that.
All right. Christina Paxson is the president of Brown University. Chris, we thank you very much for your time today here on
Okay,
Bloomberg
thank
Bay
you
State
very
TV.
much. Take care.
Thank you. All right, coming up, we're going to talk about Wall Street bonuses. They are getting bigger in the bonus season. That'll be coming up shortly. But first, let's get a check on those markets at our world headquarters in New York with Charlie Pellet.
Thank you very much, Tom Maroney. 16 minutes to go before the closing bell on Wall Street. Stocks at or near session highs. Stocks are on track for their biggest four-day rally since November of 2020. Dip buying in battered technology shares is resuming. Right now, we have got the S&P up by 41 points, up 0.9%. The Dow up 240 now, up by 0.7. NASDAQ full of tech names up by 60 points. That is a gain of 0.4%. The NASDAQ 100 index up by 0.7. Uneven gains, though. Russell 2000 on the minus side, down by 1.1%. Dow Transport's up now by just about 0.8%. 10-year yield 1.77%. Spot gold pushing higher by 0.2%, 18.05 the ounce. West Texas Intermediate crude oil up 0.1%, 88.32 a barrel. After earnings, Alphabet, parent of Google, up by 7.7%. General Motors, after earnings, down 1%. PayPal plunging the most ever, 24.5%. After the bell today, Facebook, Meta Platforms Inc., higher now by 1.4%, also reporting Qualcomm up by 6%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. As we do each and every day around this time, we bring in Kriti Gupta. She's markets correspondent here. She joins us on the phone from New York City. She has her chart of the day today, and it's a perfect day to be talking about this because we're talking tech, Kriti, and we, of course, have Meta Platforms after the bell. And we're still digesting Alphabet yesterday. Yeah. Woof, woof.
Was that the dog?
Yeah, it is the dog. I
So-
warned our producer, Paul, and he said he wants Harvey on the show, so naturally Harvey made an appearance.
I love it.
Hello, Harvey.
Yeah, let's talk chart of the day, because it really is all about tech. what's interesting to me is that when you talk about tech, it falls under so many categories, right? Inflation hedge, growth play, safe haven bid. But you don't really hear a lot of people say, well, this is actually a really cheap way to get into the stock market, because valuations are something that most people just don't discuss when it comes to tech, right? Especially in the last 2 years, you've seen a lot of theme-driven trading, really more of a reaction to that COVID risk or the Fed or what have you. So today I decided to look at the price-to-earnings ratio, the forward price-to-earnings ratio of the NASDAQ 100 compared to its ratio back in the last 10 years or so. And if you look at what the trend lines are doing, essentially you see this uptrend over the last 10 years, pre-COVID, the idea that tech is getting more and more expensive and it's getting higher and higher valuations, and then it kind of skyrockets in 2020. But then, since then, you see a lot of these like kind of mini corrections that are always consistently tech-led, and you see these blowout earnings. So it's actually kind of reversing that trend that you saw in the decade prior, and it's getting cheaper and cheaper. Basically, what this means is that tech is still really expensive. It's still really highly valued. But at the end of the day, it is kind of coming back down, and that's good news for people who do want to get into the tech business.
No, it's a really smart perspective, I think, on certainly the tech market right now, because we've been trying to gauge, right, Creedy, that as we've seen the correction, certainly in the tech sector, so what does it mean for valuations, and is it more attractive? And this is why when we get these earnings from these big names, you know, whether that recalibration now makes more sense and provides an entry point for investors.
Yeah, exactly. And then add on to the fact that you have this stock split coming from Alphabet, right? And this follows, of course, the ones you saw from NVIDIA, from Apple as well. The idea that you want to get more kind of bidders and more investors into this sector, which has largely been seen as one that only, say, hedge funds can really dive into, because prior to the stock split for Google, I mean, shares are $3,000. I think for Amazon, it's the same thing. That's going to really factor in as well, because now it's not just these valuations that matter for the institutional crowd, they matter for the retail crowd too, and that's why this chart is so important.
All right, we're going to leave it there. Hey, Creedy, thank you so much. Creedy Gupta, she's markets correspondent at Bloomberg, on the phone in New York City along with her dog, Harvey. Was it Harvey?
Yeah, it was Harvey.
Harvey,
woof,
cute
woof.
name. I love it.
Thank you so much, Creedy Gupta. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg editorial board. Since the early days of the pandemic, the U.S. government has suspended payment requirements for federal student loans. During the Omicron wave, President Joe Biden once again extended the pause, the fifth such delay in less than 2 years. He should make it the last. Pausing student loan payments made sense at the height of the pandemic, when much of the U.S. economy had shut down. There's less justification now. Some Biden allies are pushing the White House to extend the pause again or to cancel student loan debt altogether before payments are set to resume in May. Biden should refuse. Doing so may disappoint progressives, but it would promote fairness, cut the government's losses, and reduce uncertainty for borrowers themselves. This editorial was written by the Bloomberg editorial board. For more Bloomberg opinion, please go to bloomberg.com/opinion or OPIN GO on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, got about 11 minutes, well, call it 10 minutes exact, left in today's trading session. Let's get to it with our Drive to the Close guest. Michael Rosen is co-founder and CIO at the multi-asset investment firm for institutional and private wealth investors, Angelus Wealth Management. He is on the phone in Santa Monica, California. Michael, nice to have you here on Bloomberg. How are you?
I'm great, thanks. How are you? It's 70 and sunny out here.
That's a little cold. It should be 72.
It's a little.
As a Californian, I can say it's kind of a cold day.
It's not what we get out here in New York. It's warm though. It's a little bit more sunnier on Wall Street. Has been the last 4 days or so. How do you read the market trade?
Well, I think we saw a correction of 10% or so in the S&P, and just a rotation out of expensive tech stocks, and the market a little unsettled around what Fed policy is going to look like, along with some variability in data due to the Omicron variant. So a lot of things going on causing the market to sell off a bit. But I think if you do not think that the economy is going to go into a recession, which is my view, then 10% corrections historically have been good buying opportunities, and I think the market just sort of realized that a couple of days ago, and that's why we're up.
So did investors miss the opportunity to buy, or is it going to be kind of a rocky road for the next few months?
No, I don't think investors missed the opportunity to buy. I mean, we're still off our highs here, although obviously we've had a nice little bounce back here. Again, I think the underlying fundamentals of the economy are still pretty strong. I think the economy will continue to grow, and obviously questions around inflation and Fed policy and where interest rates will go. But rates have come down off their peaks here. The curve is flattened, and generally the Fed is still pretty accommodative. Even with all the comments around Fed tightening and concerns about inflation, the Fed today is still in the market buying bonds. The balance sheet is still expanding. Interest rates, Fed funds rate is still at zero. So still a very accommodative policy and supportive of assets at the moment.
So does the Fed then potentially, Michael, need to shock, as an equity investor, as an investor overall, managing portfolios for institutional investors, high net worth individuals who are looking at all different kinds of asset classes, does the Fed, though, to some extent, are you looking for them to shock the markets a little bit with a 0.5 point increase? Would that be a good thing maybe for the markets and taking some of the fluff and some of the concerns about inflation out? Or do you think that could be potentially an overdone move by them?
Yeah, I don't think the Fed's going to do that. I think a 25 basis point move, a gradual marginal move, I just don't think they've really fully embraced the idea that inflation is a big concern, and the markets have not embraced that at all. We see break-even assumptions have been coming down. The market thinks that inflation over the next 10 years will average actually less than 2.5% a year. So the market's not concerned about inflation. The Fed isn't either. I don't think the Fed's going to make any dramatic moves. I do think the Fed is, and the market actually, is perhaps underestimating the inflationary pressures that are still in the economy, and the Fed is behind the curve. And so I do think that there's a risk that the Fed will have to move further and faster at some point. But my sense is that at the moment, the first hike is just going to be a 25 basis points, as they, I think, signaled.
Hey, we've been talking a lot about the jobs report this week because the range is just massive, and look what we saw from ADP today. Economists surveyed by Bloomberg expect 150,000. The range, though, goes from negative several hundred thousand up to positive several hundred thousand jobs added.
It's like the Suez Panama Canal.
Yeah, like at the length, not the width, right?
Yeah, right, exactly.
Yeah,
the length.
it's just a massive variability there. I'm wondering, Michael, how investors should read into that, if it is a big miss. I mean, who knows what the market reaction will be, but does that change your opinion about the fundamentals of the economy at all?
Yeah, so the ADP report this morning was obviously a huge surprise on the downside, and you saw the market react very quickly. Bonds moved up very sharply, but have since really come down, and now they're I don't know, maybe flat, slightly up for the day. But so an initial big reaction in the bond market. Stock futures never really moved much. So the stock market doesn't really seem to be paying attention. The bond market did. I think this sort of goes to the volatility that we've seen, some of the turbulence that we've seen in the markets over the last month or so, because we're getting a lot of data and it's kind of all over the place. And a lot of it just still relates around the Omicron variant and the impact that that's had on some of the economic activity, along with just concerns about where inflation's going and policy is going. So there's just a lot of stuff going on here, and that's what I think is leading to this volatility. I think the Friday report, all over the map. I have no idea where it's going to come, but my sense is, though, that investors will probably look through, at least in the stock market, because the underlying economy is strong. The labor market is tight. I just can't envision a report on Friday that would really change that bigger narrative. Again, there's variability around it due to, again, some whether it's supply constraints or the pandemic related job issues, but fundamentally the labor market is still very strong, and I think that's the message that equity investors anyway will take from the data.
Michael, got about a minute left here. So with all that you said kind of on the macro, what does it mean when you've actually put new money or client money to work? Where do you want to commit it right now?
Well, throughout January, we raised a bit of cash as the market was sort of moving up and down, and just in the last week or so, started to reinvest that cash. And I don't think it's too late either. So I think equities really are the place for investors. Bonds offer no value, in fact, negative value, and I think the economy will continue to grow.
Was that a Tina comment? There is no alternative?
Well, to a large extent, that's true, and that's to a large extent that's by design. The Fed has created policies where we have inflation and low interest rates, and forcing investors to get rid of their cash and bonds and go into equities. And again, I think as long as the underlying economy is strong, we don't go into a recession. Equity investors will perform better than investors in other asset classes.
All right, we're going to have to leave it on that note. Hey, listen, thank you so much. Michael Rosen, he's Chief Investment Officer at Angeles Wealth Management, on the phone from Santa Monica, California. Some good macro thoughts there.
Yeah, also not a bad place to be, Santa Monica. 70 degrees and sunny, right? In the beginning of February, Groundhog Day.
That is a very, very good point. I could take a little sun. All right. There's certainly some sun on Wall Street because we are seeing investors. They've certainly pushed up, in particular, the S&P and the Dow. Right now, though, we want to get to our cross-platform coverage. Head over to our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube. We are counting you down to the closing bell on this Wednesday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to the closing bells, here to help take us beyond the bell. It's our global simulcast partners, Carol Masser and Tim Stenovic. We welcome in our audiences across Bloomberg Television, radio, and YouTube. Carol, another update here. We'll take it here. Not necessarily the broadest of gains, but 0.9% on the S&P 500, 0.6% on the Dow. What are those in points?
Yeah, exactly. We'll see what the tone is, certainly after the closing bell, and looking at futures after Facebook Meta reports that stock is up about 1.2% here ahead of their results. Keep in mind, it's 5% of the NASDAQ roughly, so it does definitely have the ability to impact the trade, especially when it comes to the NASDAQ.
Yeah, a lot of the moves that we've seen today have been due to earnings and have been earnings driven. An update from Bloomberg Intelligence, our team there, more than 75% of companies in the S&P 500 that have reported earnings thus far have beat. Though, as Carol mentioned, we are not done yet. We have Meta Platforms in just a few minutes. Qualcomm,
and what is the read across, Tim, there, sorry to jump on you, from the likes of Alphabet, with really phenomenal fourth quarter spending, the advertising, the commitment from companies to be willing to spend. But it's not just Meta we look at. Qualcomm, we're going to really inside track on supply chain. Qualcomm being a company that's managed to really navigate the supply chain hell that many chip companies have had.
And it was really Stuart Kaiser of UBS, I think, putting into perspective the balancing between the micro and the macro. And right now, it's actually the market's getting a reprieve from the micro, really getting to hear from the companies, from the CEOs, the fundamentals. But in the background, and what Anna Hahn over at Wells Fargo was saying is, from the macro, you actually have some stability in yields, which is giving these equity markets a little bit of time to digest.
All right, a lot to go through here after the closing bells. We'll take you to the metaverse in just a second, but we're getting the closing bells here. The Dow Jones Industrial Average going to finish the day higher by about 200 points or so, roughly 0.6%. The S&P 500 also in the green by about 40 points or 0.9%. The NASDAQ higher by about 67 points or 0.5%. And let's take a quick look at the Russell 2000 real quick. Going to close the day down, Tim, 1% here on the day.
Hey, I'm watching shares of Spotify. Those numbers just coming out, and it's a miss on that really important monthly active users number for the first quarter, coming in at 418 million versus estimates of 422 million. The company also saying it no longer plans to issue annual guidance. They see revenue coming in at $2.6 billion for the first quarter. Estimates were for 2.6, so meeting there. But that monthly active users number, missing estimates, shares tanking now, down 9.2% in after hours.
I mean, this is after, of course, we saw that surprise rally in Spotify in the last few days. They managed to perhaps catch a bid, particularly yesterday. There's been a lot of mood music around this company, of course, when they see their focus on podcasting and some of the issues, the tension they find between their musical artists vis-a-vis some of their most popular podcasters, Seth Rogen being a key issue there. But this is a company that's too getting dragged into the misinformation space.
Yeah, exactly. And so there's been a lot of news on it. We've got some other earnings crossing the bow. You want to go to Qualcomm, guys?
Yeah, let's take a look at Qualcomm here. Second quarter, let's start with the first quarter. The adjusted EPS coming in at $3.23. That's a slight beat over the $3 average estimate that the street was looking for. Revenue for the first quarter on an adjusted basis, $10.7 billion. Street was looking for 10.4. Guiding forward to the second quarter, the fiscal second quarter here, looking at revenue for $10.2 billion. Street was looking for 9.6. And as far as adjusted EPS, $2.80 to $3 a share. That's the range that the company is giving for the forward quarter. Looking forward, the street looking on average for 2.48.
Yeah, Qualcomm got strong demand from Android phone makers. This is an important company when you think about Apple and, the companies that are the main customers of this company, that they gives you an indication in terms of demand and what they're seeing as well.
In all seriousness, though, we're going to get metaverse in a second, or meta platforms in a minute. But when we talk about sort of what the future is in this market, a lot of people are looking to chips, whether it's chips going into, phones or computers, data centers, cars, whatever
VR.
it is. And then they're looking in VR. And then, of course, they're looking to, I guess, what you could call some of the content platforms, like a Meta platforms, or to a certain extent, like what we saw yesterday with Alphabet. That is, to certain people, the future.
That's why it's going to be really important to get an update from Meta on Facebook Reality Labs, right? This idea of the Oculus numbers being broken out for the first time and getting an understanding not just of the hardware, but also of the investments that the company is making, because it's going on. This is like a full investment in the metaverse.
It's a full investment and a full rebrand of the company. And I'm curious how does this move away from just gaming and entertainment? Can it, or does it need to? Can it just be that and be profitable, or does it need to be something more practical?
Isn't it? It's about the fact that we interact no longer just in the confines of our offices, but we do that in a more virtual reality kind of a place as well. But this is a company that's committing $10 billion thus far. We want to understand what the profit implication therefore is, and also growth of people using their underlying social media, and indeed they're going to be making a big push to why you should be using WhatsApp at the moment. It's interesting though, they're going to have a supply chain effect when it comes to building those Oculus headsets. Qualcomm CEO saying that he wished he had more supply to meet the demand that they've seen. Demand from China handset makers, they say, is strong.
He did say demand accelerating across all businesses. What's interesting about, you talked about Meta, though, how much money they have to spend to really shift from being an advertising-based company to something much more. Let's talk about T-Mobile, because we've seen this stock also coming out with their earnings and moving around in the after hours. Fourth quarter revenue, that was a miss, $20.79 billion. The estimate was for $21.07 billion. What's interesting, too, is in terms of some of their users, postpaid phone net adds up 844,000. That was a little bit better than what the street was forecasting. And their fourth quarter EPS was 34 cents a share. And we are seeing that stock up about 4% in the after hours.
Yeah, I'm continuing to watch Spotify because shares are continuing to move lower in the after hours now on that subscriber miss. Spotify tumbling 15% in after hours trading after that outlook misses estimates. Caroline, you talked about the Joe Rogan controversy here. Certainly a lot of questions will be around the effects that the platform has seen. As we talked to Lucas Shaw earlier in this week, he said that despite the fact that artists like Neil Young, Joni Mitchell, Brene Brown, who does podcasts, have said they're leaving the platform or stopping to produce new podcasts on the platform, he doesn't expect that to make a big dent in premium subscribers or subscribers unless you have a name like Taylor Swift, for example, come out and say that. And we just haven't seen that yet.
Well, and this raises an issue, too. When Spotify went down this road, when you become much more of a content platform, there's always that question of how you police that platform. Similar questions, of course, that Facebook, Meta Platforms has had to deal with. And it seems like the response all along has been, well, you don't really do it. You basically just give people kind of what they want. And as long as you're not, violating the law.
Well, it was interesting, Romaine, to see what Spotify CEO Daniel Ek released on Sunday.
Here comes Meta.
Yeah, Caroline, go ahead. I know we're seeing those Meta earnings now.
Yeah, we're coming with the fourth quarter ad revenue, $32.6 billion. Their overall fourth quarter revenue, $33.67 billion, ever so slightly ahead of expectations. But remember, this is a slowdown in terms of pace of growth. It's about a 19-20% increase in revenue. We're used to in the 30s, so a little bit of a pullback there. They see their first quarter revenue being $27 to $29 billion. That is shy of where the market wanted to see this sort of growth. So here is another company where where we're having to readjust, acclimatize ourselves to what the growth really looks like there. Facebook daily active users, 1.93 billion, slightly shy again of the expectations, and basically flat from where we've seen their user base of late. So this is a company that is slowing down. They see headwinds from increased competition for time. Remember, this is TikTok. This is the company that is going incredibly focused on the short form videos that YouTube's trying to combat. We saw that weakness in Alphabet yesterday. And 2022 tax rate to be similar, though, to the year 2021. I'm pleased to say Mandeep Singh's with us, Senior Technology Analyst for Bloomberg Intelligence. And when you're reading into these numbers, what do you make of it?
Well, so clearly, I think it was inline revenue growth, but the miss was on the operating margin side. And what it shows you is this company will continue to invest when it comes to building the metaverse, really hiring more people. CapEx is going to be huge, almost growing incremental by $10 billion. And you mentioned TikTok. In my mind, they're also losing users to Roblox and the gaming platforms. So the younger demographic is really moving away from them.
Mandeep, how do we distinguish between investing in the short term, the pressure that puts on margins, maybe the initial reaction which pushes the shares down 50%, versus the long term? And as an analyst, how you look through quarter after quarter to see, but investing now, you think Amazon a few years ago, it'll pay off dividends in the end.
Yeah, absolutely. So look, their growth rate has decelerated to being in line with the digital industry growth. So ad industry is growing around, mid to high teens. That's where Facebook is growing, and it will continue to be that way because they are the scale players when it comes to social networks.
Where are the advertisers going, Mandeep? Where are they going right now?
That's a great point. So they don't have a choice. If you're an advertisers, you still want to spend on Facebook because they have the data.
Right.
They're still better off than, without IDFA.
Do people want to spend on Facebook? I know they have to. Do they want to?
Well, so from an advertiser perspective, clearly they can see Facebook is losing engagement. But guess what? If they were to allocate their ad dollars to some other platforms, they're not getting the ROI on that ad spending. So that's why they will continue to spend because Facebook still has $3 billion monthly active users across its family of apps.
Mandeep, I think the question at this point is this is a company that's pivoting and the stock has really gone nowhere since they announced their name change back in October. They're talking about spending billions when it comes to the metaverse. How questionable is this move? I mean, investors aren't buying in at this point. Do you think it's risky as somebody who follows this company and understands kind of where the tech world is moving towards?
Well, so we know Facebook has made a transition in the past, back in 2012, 2013, when they moved from desktop to mobile. Guess what? They are really betting the farm on this, and they're really early into this trend. So I wouldn't bet against, Mark Zuckerberg and his execution when it comes to the product side. But at the end of the day, look at the competition. It's really coming from TikTok and Roblox and these gaming platforms that are really focused on the younger demographic. When it comes to the demographic from 25 to, onwards, Facebook, with its Instagram and WhatsApp, is still the platform that is the scale player.
Hey, Mandeep, we should note that Facebook Meta platform sees trading under the ticker symbol Meta in the first half of 2022. We know that Roundhill used to actually have that ticker, but Facebook will start to trade under that in the first half of the year. We're seeing shares of Pinterest and Snap lower after this report. Help us understand the repercussions of this miss that Facebook reported today on what we're seeing with other companies and what we should look for from Snap perhaps tomorrow.
Yeah, so one thing is obvious is search spending is very solid. That's what Google showed us yesterday. And social media ad spending is tapering off. And part of that has to do with engagement. Like I said, engagement for all of these companies is peaked, and you're seeing decelerating trends. And as an advertiser, you don't want to allocate all your ad budget on companies that have lower engagement, and so that is why you're seeing the other social media platforms also decline here.
I'm curious if you go through the press release and the CFO Outlook commentary, it's pretty negative. They're highlighting headwind after headwind after headwind, not to even get into some of the currency issues, the Apple iOS changes that they talk about. They're talking about, of course, from advertisers that higher prices are impacting ad budgets. To Romain's point, you do want the eyeballs, but you're getting strong things like Alphabet, where ad is really strong. Are we not seeing sort of that strength continue in Facebook?
Yeah, so clearly IDFA has lowered their ability to target those ads. Facebook's USP was really, their ability to target ads, show personalized ads. That has been curtailed with IDFA, but it's not just for Facebook. It's also for Snap, Pinterest, the entire social media ecosystem. Google search is different. It's performance advertising, it's keyword-based, it's all first-party data. But I think my point here is Facebook still has its family of apps, and it has a lot of first-party data that other social media networks don't have. So I think it was a kitchen sink quarter in terms of throwing all the headwinds and negative news out there. But when you look at, the overall space, it's hard to see, Facebook suddenly falling off in terms of the top line. So they will track, I think, the digital ad industry growth going forward, at least for the next few quarters.
All right, we are talking Facebook Meta platform earnings right now. We should point out just real quickly, the shares are down 18% here in the post market. Remember, this is a stock that doesn't really move to those extremes. Moves like this are extreme. If it does do this in the cash session, this would actually be one of the biggest declines that we've seen in Meta platforms going back to 2018. We are in conversation with Mandeep Singh, Senior Technology Analyst for Bloomberg Intelligence, who's helping us walk us through Meta platform earnings. The numbers themselves overall seem to be disappointing investors. The revenue numbers coming in a little bit light. The forecast also coming in a little bit light, but it's really some of these capital expenditure numbers and the idea that ad growth may not necessarily be as strong as it was, that may be giving people some pause here, Mandeep. Talk to us a little bit about this idea of what that CapEx spending can maybe do to make up for whatever longer-term deficiencies we may see in ad spending.
Yeah, so look, they've talked about getting into NFTs and really some of the new concepts that are out there. So the risk for, an app like Instagram is all the influencers move away from Instagram and create their own NFTs. So Facebook really wants to be ahead of that trend in terms of catching that trend and making sure that influencers don't go away. Similarly, with the Core Blue app, you have to embed, what Roblox is doing on the gaming ecosystem. You have to bring that kind of content in the platform to drive engagement.
Mandy, what I don't understand, though, is they're talking about the capital expenditure being driven by data centers, servers, network infrastructure, office facilities. And they say that actually, look, yes, they're going to invest in AI and machine learning across their business. When it comes to overall the focus on the reality labs, they say, look, they may require more infrastructure in the future, but right here, right now, they're saying they do not require substantial capacity today. I thought we were going to front load this investment in reality labs, but that's not the case.
So maybe right now there aren't enough chips available for them to, but at the same time, they are betting big on Oculus, and they had a great holiday season when it comes to unit shipments on the Oculus side. So clearly, I think they are taking the entire company and also the talent on that side. I guess it's a longer-term strategy, and investors won't give them a pass like this, quarter after quarter.
Mandy, the losses, they're breaking out family of apps and reality labs. You've gone from $4.5 billion in losses 2 years ago to $10.2 billion in losses. It's a parentheses, it's a negative number. Of course, being totally offset by the revenue and the income from the family of apps, but losses are accelerating. Is that to be expected?
Yeah, they are selling their Oculus device at below the cost price.
Okay.
So they are really subsidizing, the
just for market share?
Just for market share. They want to be the #1 Oculus VR headset out there globally, and they are really trying to subsidize it upfront because they know once they have the install base, and remember the 800-pound gorilla here is Apple. They're going to come up with a gear that's attached to their phone, so they really want to make sure that they gain that traction in the meantime.
Well, so Mandeep, I mean, you've got to put out a report tomorrow, and I'm just thinking, what's your headline on this report? As you see a company that is thinking about the future, that has potential, no doubt about it. You've been talking this week about the market size of that. I mean, what's the headline for this company?
Well, so really, it's a hope-based strategy, but one that makes sense because clearly every company is talking about metaverse. Microsoft spent $70 billion buying a $9 billion revenue run rate company in Activision. I think what Facebook has to show is to show the investors that all the incremental CapEx is going to result in revenue. Think of the Activision $9 billion revenue.
Well, they're certainly not buying the metaverse story today because the revenue forecast missing estimates and fourth quarter user growth short of expectations. That's certainly what's sending shares lower in after hours now. Mandeep, when we do think forward to the future of meta platforms, what does the actual metaverse look like in terms of revenue for the company? Where do they get revenue? Is it still based on advertising? What does that look like? Because right now, the vast majority of this company revenue comes from advertising.
I think metaverse is a play for them to diversify that revenue and get into more transaction-based revenue as well. I talked about NFTs and, just developing a marketplace where you can have more token-based revenue. So advertising will definitely be a major portion of it. But I think with advertising, it will come a lot later in the metaverse once you have the engagement. Initially, it will be more about driving transactions. Like I said, token-based monetization is another avenue they'll look to tap.
Hey, Mandeep, and let's just remind everybody, Facebook shares, Meta shares, they're now down about 18% in the after hours, so they're sinking big time. Revenue forecasts missing expectations and estimates, fourth quarter user growth short of expectations. What's interesting, too, and you said, we're all talking about Meta. If Facebook had not come out in the fall and started talking about Meta and the name change, would we be having as much of a conversation if they hadn't kind of opened the door?
Yeah, we probably won't. And look, between that, we have seen 2 or 3 big acquisitions, Take-Two, Zynga, Microsoft, Activision. So clearly, everyone is focused on acquiring content. And that's a big question mark when it comes to a metaverse strategy. How will Facebook build all that content? It can't be all organic. So they should be able to acquire something. But in this kind of regulatory environment, they can't even think of acquiring anything, so they have to do this organically.
Absolutely. I mean, they're under the microscope a lot right now, Mandeep, and we sort of wonder if they can even sort of entertain the idea, Carol, of what they're doing. Yeah. I mean, once again, the headlines here on Facebook, certainly a bit of a disappointment. We'll see if this ends up being just sort of a one-quarter thing, Caroline, or whether this is more of a longer-term shift, but a shift that could cause investors a little bit of pain as they make this transition into the metaverse.
1/5 of their market cap, kind of a pain, of course.
and it's dragging down all the other names. You mentioned them earlier, Tim. Snap down 18% right now. We also talked about Spotify. You might as well throw it in that social media space. That's down 17. Twitter down 9. Pinterest down 9. So many names in this space attached to that are getting dragged down by some concern here as to what's going on.
Yeah, absolutely. If we were looking for a savior in Meta in terms of maybe giving another kick to the upside for tech, it's not necessarily what we're going to see today, Caroline.
Mandeep Singh is going to be joining us as we go dig into the world of Meta a little bit further on. Yeah. Senior technology analyst from Bloomberg Intelligence, Romain.
Okay, as we were obsessing, of course, over Meta platforms, we had another actually big decliner today in the after-hours trading, and that's Qualcomm. The chip maker had initially risen in after-hours trading on the back of its earnings, now down as much as 8.5%. Ed Ludlow out in San Francisco joining us now to talk a little bit more about this. Ed, overall, the top-line numbers, the bottom-line numbers all seem to beat expectations here, but it looks like some of the commentary in here might be giving investors some pause.
Yeah, this is fascinating. All the signs point to strength, right? A really bullish second fiscal quarter outlook. Remember, this is a company that in November had an analyst day and gave a multi-year horizon saying that they'll hit $46 billion of revenue in 2024. So it's hard to understand here what's driving the market. Maybe it's the commentary around supply still being limited, but improving. Maybe this is a stock that did well in regular trading on Wednesday and it's sell the news kind of stuff. We had a good kind of vibe that Qualcomm's doing well in its diversification efforts. The story under Cristiano Amon has been move away from the traditional strength, smartphone, it's the biggest maker of smartphone chips, towards new areas like automotive and IoT. Both of those did great in the quarter just gone, so it's hard to know what the sell-off is attributable to.
All right, Bloomberg's Ed Ludlow with a very quick update there. Of course, the big movers in after-hours trading include Qualcomm down 4.6%, Meta Platforms down 20% right now, Carol.
All right, that's going to do it. Yep, some big movers in the after-hours. That's going to do it for our cross-platform coverage Beyond the Bell on radio, TV, and YouTube. We'll see you again, same time tomorrow.
This is Bloomberg Business Week with Carol Massar and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
It's Bloomberg Business Week. Tim Stenovic and Carol Massar. I know Charlie Pellet has been keeping an eye on what's been happening in after hours. Hey there, Charlie Pellet.
Well, hello there. Indeed, a fire hose full of earnings. So let's recap, reset. Yes, we got you covered. Here's what's going on. After the bell, we did hear from Meta Platforms, formerly known as Facebook. Big news, stock plunging after missing every benchmark. Facebook sees headwinds from increased competition for people's time. Also issued a revenue forecast of missed estimates. FB on the ticker, shares lower now by 20%. 20%. Qualcomm raising its outlook for second quarter revenue with demand for its chips accelerating across all businesses. Qualcomm shares down now by almost 7%. After a month of controversy involving podcast host Joe Rogan, Spotify disclosed a more immediate business problem, its growth in the first quarter of the year. Company said it would end the first quarter with 418 million total users and 183 million paid subscribers, shy of Wall Street forecasts on both counts, shares plunging by 19%. T-Mobile also reporting earnings after the bell. It did beat Wall Street estimates for fourth quarter profit and projected 2022 subscriber growth. Shares after hours, T-Mobile up now by 6.7%. Another day of gains for the U.S. stock market. Stocks posted their biggest four-day rally since November 2020. Dip buying in battered tech shares continued. S&P up 42, up 9/10. The Dow up 224, up 6/10. NASDAQ up 71. That is a gain of 0.5%. 10-year up 5/32. 10-year yield 1.76%. Spot gold up 0.3, 18.06 the ounce. West Texas Intermediate crude down 0.3, 87.91 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So some big earnings after the closing bell. Let's talk a little bit more about Facebook, Meta, and also Qualcomm, because both of those stocks, they are down in the after hours. Facebook shares down almost 22% and Qualcomm down about 5%. Let's get to Dan Morgan. He's back with us.
Yeah, Dan Morgan is Senior Portfolio Manager at Synovus Trust Company, approximately $22.6 billion in assets under management. Dan joins us on the phone from Atlanta. Shares of Facebook, wow, down 22%. Meta Platforms, excuse me, in the after hours.
That's a fifth of the market cap going to be just sliced.
It's a wild move, Carol. And look, we'll see what happens tomorrow. These are after hours moves, and we'll see what we hear on the call as well, because that could change things. Revenue forecast misses estimates, fourth quarter user growth short of expectations. The company says that the Apple iOS changes hurt growth. You heard all about it just in the last few minutes. Dan, you've had some time to dig into this report. What's sticking out to you?
Hi, Tim. Hi, Carol. You know, it's interesting when we look at the top line growth coming out of Meta, it actually beat consensus, right? The street was looking for $33.43 billion. They came in at $33.67 billion. Also noticed that advertising revenue was above consensus at $32.64 billion. That was up 22%. And that's something we would expect would be strong top line growth, especially in advertising, as it relates to the Alphabet number that we had a couple days ago. We know they had a strong beat on ad revenue, up 33%. I think you mentioned it, Tim, in terms of, some of the struggles that, boil down to the bottom line in terms of cost. I mean, we know that in the last quarter, being the third quarter, they had an impact of about $300 million related to the iOS Apple privacy change. And then also costs associated with making some of these recent structural changes in terms of their reporting and this new focus that they have on this Reality Labs group, which is their virtual reality Oculus group. I think it did a little over $800 million on the quarter, which is a fraction of the total revenue they did on the top line. So I think right now, not surprising that the top line numbers were so strong, but it was kind of interesting that they didn't do a little bit better with all their other metrics, right? Daily average users, monthly average users, and EPS, and then they came out and guided for lower first quarter next year. So it's kind of a confusing number, being that top line was so strong.
Is it so confusing that the stock should be down like 20% in the after hours, in your view?
The street right now, as you know, Carol, a week ago was selling everything that had a tech name next to it. And then we had those good numbers out of Microsoft, and then we rolled with Apple, and everybody got bullish on the group again. So there's really a short stick right now for tech. I mean, if you don't execute on every single little matrix, they find one little number they don't like. They want to bring you down. And I just think the bias right now against Facebook and tech is there. And unless you execute and really perform exceptionally well, they're going to find a reason to bring your stock down.
But, going into this, Dan, the stock, since the company announced the name change and the focus back in, I think it was October, it hasn't done much. And then to see the drop off here, is there nervousness among the investment community that while they are spending big on the metaverse, which they've come out and said, that there are going to be periods, we don't know how many quarters, where as they reorient the ship, that it's going to be a very different maybe earnings picture and revenue picture for this company?
Well, you're right, Carol. And, as they continue to shift the strategy and they have costs associated with it, and then you're betting on something that may or may not work out, right? I mean, you saw the numbers.
Betting big,
they
too.
think they sold 10 million Oculuses, right? So the units are out there, and they're going to really bank on that going into the metaverse. And, you know, I don't know if that strategy is going to pay off for them. I mean, think about Alphabet with all their other bets.
Yeah.
Whammo and all this other stuff that, you know, is still kind of fun to talk about, but really hasn't come to any fruition in terms of financially speaking. So I think there's some...
Still an
there's some
advertising
question marks.
company, right?
Thank you. Yeah.
Still is an advertising company. That's what they really make their money on, Carol and Tim. And, you know, they're trying to recast it, but I think that's why the street's kind of scratching
I'm
their
so
head.
glad you said that. $32,639 million of the $33,671 million. So 97% of the revenue in the most recent quarter
It's advertising.
came from advertising. I mean, we're talking like rounding errors with other revenue and Facebook Reality Labs. I'm wondering though, Dan, when that starts to really shift, because with Facebook's move to the metaverse, and I was getting to this with Mandeep, does that represent a shift in the way that the company makes money, or is it still an advertising company? It's just doing that through a completely different platform, which is the metaverse.
Right. So you were talking before about how they could build that out via potentially developing organically or making acquisitions. So they have to kind of build out this new platform, but it's still kind of the same game, right, that they're playing. It's just in a different little playroom, right, so to speak. So again, I think Tim and Carol, there's still some, you know, questions whether that strategy is going to pay off for them. And they're not the only one getting in on it, right? We've heard Apple talk about it. I don't know if you guys sat on the Microsoft Activision conference call when they announced that deal. They mentioned that 7 times, you know, in terms of that's the future, right? And so
I feel like I'm being managed a little bit, Dan.
I'm sorry?
I feel like I'm being managed a little bit.
Yeah.
Well, you know, it's interesting. I'm looking at our live blog on Facebook Meta. Kurt Wagner, tech reporter who follows this, he says Facebook reported 2.91 billion monthly users in the third quarter, reported 2.91 billion monthly users in the fourth quarter. He goes, I don't know if I've ever seen a quarter where Facebook's core social network didn't grow. I mean, do we need to be asking that? Are they tapped out in terms of bringing in new users to the platform?
Well, you're right, Carol. Of course, they missed the estimate, 2.95 billion. And we've talked about this before in terms of Facebook's future going forward. We know that domestically they are, you know, pretty saturated, kind of like Netflix, right? Everybody's kind of got Netflix. Everybody's got kind of Facebook. And we know going forward that the future for them was developing foreign markets and, you know, areas where they're not as dominant. And, of course, going into the metaverse. So it is interesting. I can't remember a quarter where they didn't have some, you know, Q over Q growth in terms of users. So that does make you kind of scratch your head and say, wow, they are really starting to mature. You know, they really do need to find a new avenue of growth, right, in terms of adding new subscribers. So is this the future? That's what everybody's kind of wondering. Yeah.
Dan, it raises the question, Facebook shares trading in after hours right now at about $251 a share. That's a level, Carol, last seen on January 12th, 2021, so about a year ago. Lowest level in about a year, down after hours more
Investors
than 21.
aren't happy.
They're not happy. But Dan, it raises the question, is this a buying opportunity for Facebook?
I still think, you know, Facebook is a stock that's on our buy list. We do hold it. I still think there's some question marks in the short term that we've kind of reviewed in our discussion today that you obviously have to get your arms around, you know, in terms of how long it's going to take for them to work through, you know, some of these cost issues and how long it's going to impact the bottom line. I would say right now the stock's definitely going to have a black cloud over it for a while. So I think you've got time in it if you're watching it, you know, and you're still, you know, embracing the fundamentals.
Well, we talk about recalibration. We're definitely seeing it in shares of Meta, Facebook. Hey, listen, just before, we have about a minute or so left, Qualcomm down about 2.8% in the after hours, also out with its earnings. And let me just bring up, in terms of the key headlines, second quarter revenue, 10.2 to 11 billion. So it looks like that's a pretty upbeat forecast. That's a rosy forecast. They talk about the CEO saying, I wish I had more supply to meet demand. Demand from China handset makers is strong. Strong demand from Android phone makers. What are your thoughts on Qualcomm?
Well, Carol, to me, the Qualcomm number was fantastic, and it's not a surprise because we know that last week Apple came in with iPhone revenues of $71.63 billion. That was up 9%. That was a huge beat. We know that Qualcomm makes the chipsets that go into the modems of the iPhone 12 and 13. They get about 20% of their revenues from Apple. And, you go down and look at these numbers. Not only you mentioned the guidance in the second quarter, but also the results on this first quarter. Handsets were up 42% in terms of revenue. QCT, which is their chip group that provides basically their semiconductor chip group, that was very, very strong also. That was up 35%.
So why are we down?
I'm kind of wondering, why the stock was down. The only thing I could possibly say is just kind of going back to what we talked about before, which is the stock had a nice ramp up after those Apple numbers. So everyone's kind of like expecting them to beat. Right. And then, of course, when they do beat, everyone's like, oh, we already do that. And then they start selling the stock. So you can never win with the technology sector, right, guys?
It's not easy being a tech name. Dan Morgan, you are amazing.
It's been pretty good over the last decade. Okay, let's put it into some context. Look at that QQQ, right?
Especially those semis, too.
Yeah.
Dan Morgan, thank you so much. Senior Portfolio Manager over at Synovus Trust Company. And we are seeing Qualcomm shares down about 2.5%, and Facebook Meta still down about 22%.
Hey, let's head to Charlie Pellet, because I know he's been watching the way things are going in the after hours. Hey, Charlie.
Well, hello there. Plenty going on. Meta Platforms, formerly known as Facebook, plunging after missing every benchmark. Shares now down by 22.45%. Dan Morgan is with Synovus Trust. You heard him live right here on Bloomberg Business Week moments ago talking about the quarter.
Not surprising that the top-line numbers were so strong, but it was kind of interesting that they didn't do a little bit better with all their other metrics, right? Daily average users, monthly average users, and EPS, and then they came out and guided for lower first quarter next year. So it's kind of a confusing number, being the top line was so strong.
And right now, Meta Platform down by 23.3% after hours. Also reporting the other big name, tech name, Qualcomm. It is the biggest maker of chips that run smartphones. It gave a bullish forecast for the current quarter after demand surged for the devices and the company pushed into new markets. Its shares lower right now by 3%. Stocks higher today, posting their biggest four-day rally since November 2020. As for the overall market backdrop, Michael Rosen is Chief Investment Officer at Angelus Wealth Management. He, too, was a guest right here on Bloomberg Business Week.
If you do not think that the economy is going to go into a recession, which is my view, then 10% corrections historically have been good buying opportunities. And I think the market just sort of realized that a couple of days ago, and that's why we're up.
Today, indeed, the S&P up 43, higher by 0.9%. The Dow up 224, up 0.6. NASDAQ up 71, up 0.5. 10-year yield 1.76%. Spot gold up 0.3, 18.06 the ounce. And West Texas Intermediate crude down 0.2%, 88.04 a barrel. Again, repeating our top story: Facebook plunging after earnings, down now by 22.8%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie Pellet. Well, think back a year ago, many were calling it the revolution against Wall Street, the rise of the Reddit investor, meme stocks, betting against the big guys and their shorts. Was it really a revolution, though? And did big Wall Street really lose out? This is all in a new book.
Spencer Jacob is the author of that new book. It's called The Revolution That Wasn't: GameStop, Reddit, and the Fleecing of Small Investors. He's a columnist for the Wall Street Journal and joins us on the phone now from New Jersey. Spencer, I want to start just at the beginning here, okay? Because you go into this in the beginning of your book. Take us back to a little over a year ago when you had that moment, thanks to your sons, that you realized that this was a story you needed to tell.
Yeah, thanks for having me. I was aware of Wall Street Bets as a reporter at the Wall Street Journal because even, say, starting a year before that, you would see some stock go up a lot. You'd look for news, wonder what had happened, and then somebody would say, oh, yeah, they talked about it on Wall Street Bets. So it was a phenomenon before that, but this was something completely different, and not just because the stocks went up so much. My oldest boy, who was home, and I was home too because of COVID-19, in January 2021, said, hey, Dad, are you going to learn about GameStop? And I had driven him there.
Thank God for kids.
Yeah, exactly. I'd driven him there about 8 billion times in his life, and his two younger brothers as well. But I had no idea what he was talking about. I looked and saw it had gone up a bunch. And the gist of it was that a friend of his had bought it, and I said, listen, it doubled in the last 2 days. That's great, but he shouldn't stick around. I've seen this play out a dozen times. And he said, no, he's not going to sell, which is a strange thing to say. But that was central to this whole plan that was hatched online, which was not just to buy the stock, but then not to sell it, to attack short sellers. And it wasn't an airtight trap, as we kind of can see now in hindsight. But that was the gist of it, and that's why it was so potent, and that it just took on a momentum of its own.
So it did feel like the little guy beating the big guys, but that wasn't necessarily the case, as you write and lay out in your book.
It wasn't the case. I mean, first of all, once you look at what happened just in that period of 10 or 11 days, the hedge funds that took huge hits, and there's one that lost almost $7 billion in a matter of days, and there are other big losers.
You're talking about Melvin, right?
I'm talking about Melvin Capital, Gabe Plotkin's Melvin Capital. Gabe Plotkin was one of the best paid men in the world the year before. He took home $846 million personally the year before. He was richly rewarded and had a great track record until this, and this just blew him up. He lost over half of his investors' money. But others lost money too, that are less known. Melvin was the biggest loser and the best known loser. But one or two hedge funds, first of all, is not Wall Street. Wall Street's a big place, and most of Wall Street is made up of middlemen. And the middlemen like it when the little guy is active and thinks that he can beat Wall Street and pours a lot of money into new accounts and things like that. So that's one aspect of this, is that they really had a great payday. If you look at from Morgan Stanley to Goldman Sachs to Citadel Securities, although they don't release results, we know that they had a tremendous amount of revenue, and we know that all these other companies had a very good time during the meme stock squeeze, before, during, and after. And furthermore, we know that a lot of funds made a bonanza on the meme stock squeeze, whether they rode the coattails of it or they just were in the right place at the right time. And finally, a lot of corporate insiders made fortunes off of this, just being at the right place at the right time, just dumb luck.
Does the retail investor, does the small investor, does he or she stand a chance in this day and age? Or has he or she ever stood a chance?
There's always a chance. Listen, if you spend a lot of time in a casino, and Wall Street often is compared to a casino, then you have no chance. The more you're there, the higher your chances of losing. Wall Street, you do have a chance because there's a general upward trend in share prices. But basically, it's like the inverse of your level of activity dictates your success. And so when you have a lot of especially young people getting to the market and getting in through an app like Robinhood that really encourages activity. And it's a company that makes more money when you are more active. They charge zero commissions, but they do earn money when you trade, and especially when you trade sort of recklessly. Then you're kind of stacking the odds against yourself, because study after study shows that performance is inversely correlated with activity and inversely correlated with how often you check your account. And that's the way that these young people, primarily young people, who drove this, got into the market. And that's how they weaponized their accounts, by these brokers that were very intuitive,
right,
that had allowed them to use options and all this stuff. And as a group, we know that they're not doing well.
All right, we're going to come back to Spencer Jacob. He is the author of The Revolution That Wasn't GameStop, Reddit, and the Fleecing of Small Investors. He's also editor of the Heard on the Street column for The Journal, and previously wrote ahead of the Tape for The Journal and the Lex column for the Financial Times, and we're going to continue the conversation. In the meantime, do want to mention that Facebook is down 20% in the after hours. Their revenue forecast missing estimates, fourth quarter user growth short of expectations. That is certainly catching a lot of attention. EPS missing estimates, and the revenue topping analyst figures, so that did play out. Companies saying Apple iOS changes hurting growth, but it's a lot about this company pivoting again and spending a lot of money, and what does that mean?
Yeah, and again, wait for commentary from Mark Zuckerberg and Sheryl Sandberg on that call happening in just a few minutes. Hey, let's head down to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden is relaunching the Cancer Moonshot, a program conceived and begun in the Obama administration when Biden was vice president. In order to tackle cancer, he's proposing the Advanced Research Projects Agency for Health.
ARPA-H will have a singular purpose to drive breakthroughs to prevent, detect, and treat diseases including cancer, Alzheimer's, and diabetes.
Biden says it's his presidential priority to reduce the cancer death rate by at least 50% over the next 25 years. Biden lost his son to cancer nearly 7 years ago. The House of Representatives is taking up a bill to subsidize semiconductor manufacturing, supply chains, and scientific research and education. But it's not likely to gain any Republican votes. Bloomberg's Irv Chapman has more from Washington.
Chairman Hakeem Jeffries led a Democratic caucus briefing on the bill's provisions.
It will invest in research and development, making sure America can continue to lead the technology and innovation economy. It will make clear that Democrats deliver for the people.
Ranking Foreign Affairs Republican Michael McCall said the House should just have accepted the bill the Senate passed.
It threw out all the good stuff and instead puts a green climate change slush fund, much of which will actually go to China to help produce their green energy.
McCall explained that solar panels and batteries would have to be imported from China. In Washington, Irv Chapman, Bloomberg Radio.
Thousands have gathered in Baltimore today to mourn the loss of 3 firefighters who died after they were trapped inside a burning vacant row home when it partially collapsed last week. Global news 24 hours a day on air and on Bloomberg Quick Take. I'm Nancy Lyons. This is Bloomberg.
All right, Nance, thank you so much. We're going to get back to Spencer Jacob and talk about his book, The Revolution That Wasn't, looking at GameStop and Reddit as he says, the fleecing of small investors. We do want to talk a little bit more about Facebook, though. Stock down 20% in the after hours.
Yeah, shares plunging in after hours trading. The shares are sinking as a result because of fourth quarter user growth falling short of expectations, earnings per share missing estimates, revenue did top analysts' figure. The company also saying that Apple's iOS changes has hurt growth. We knew that going into this.
Right.
Carol, it was a miss almost completely across the board. The company, it's having a hard time at least convincing investors that this shift to the metaverse is one that's going to be perhaps come sooner than later.
Exactly. And they've talked about spending, $10 billion. They said it's going to impact operating profit. Our Naomi Nix on our live blog that's tracking these earnings says it's going to be interesting to hear more about Mark Zuckerberg and what he has to say about the company's investment strategy for Reality Labs. Keep in mind, this is the division that houses its virtual reality-powered Quest 2 headsets, but it's the first time that it was broken out, so we got to see exactly the numbers that go along with this group.
But it was a tiny number, right? It was south of $900 million in revenue for the most recent quarter. And to put that into context, the company brought in over $30 billion in the quarter. 97% of the revenue that it brought in the most recent quarter was from advertising. So Reality Labs is a tiny part of that.
No, absolutely.
But the growth is there. Growth, right? Because they're starting from such a small base.
But here's just something, like think about Amazon. When they were creating Amazon Web Services, I'm sure at some point it was small as they were building out the infrastructure.
And we didn't know for years what they were spending or the margins there.
I remember, I think it was a Business Week story that came out and said, "Hey, did you know that when you're watching Sopranos or something, guess where? Whose servers it's on." So I don't know. I guess time will tell.
Yeah.
As we learn more. You actually, maybe if we have time later, I have an interesting story about the metaverse.
Yeah, we'll talk about that. It wasn't through Facebook either.
No, but a real application, and it kind of made sense to you. All right, you're listening to Bloomberg Business. We're going to get back to Spencer Jacob talking about his book, The Revolution That Wasn't. This is Bloomberg Radio.
Headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Facebook parent Meta Platforms says user additions stalled in the fourth quarter. It also gave a disappointing forecast for the current quarter, raising concerns about the company's future growth. Shares are now plunging 20% in late trading. Also reporting after the bell today, Qualcomm, it is the biggest maker of chips that run smartphones. It's slipping in late trading after efforts to expand beyond its base of smartphone chips hit some snags in the latest quarter. Right now, Qualcomm lower by about 2.5%. Stocks higher today with the S&P posting the biggest four-day rally since November 2020. Dip buyers in battered tech shares continue today. S&P was up 42, up by 0.9%. The Dow up 224, up 0.6. Nasdaq up 71. That is a gain of 0.5%. 10 years up 4/32. 10-year yield 1.77%. Spot gold up 0.3. 18.07 the ounce. West Texas Intermediate crude down 0.2, 87.99 a barrel. Again, repeating, Facebook plunging after hours, down now by about 21%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. I want to get back to our guest at this hour. Still with us is Spencer Jacob. He's editor of the Heard on the Street column at The Journal. He was formerly also wrote the Lex column for the Financial Times. His new book out, The Revolution That Wasn't, GameStop, Reddit, and the Fleecing of Small Investors. He's still with us on the phone in New Jersey. So, okay, if it wasn't a big win for retail investors that you write about in your book, so is there no hope for retail investors? I mean, I thought financial innovation, Spencer, was going to be kind of the savior for the little guy when it comes to the financial markets. Should we all give up all hope or not necessarily?
No, we shouldn't. No, Carol, I mean, that's the irony of this story. You know, if you look at one of those charts people show you, you know, if you had just bought stocks back in 1926 and, you know, not sold and whatever, not that anybody holds on for that long, it's all really a myth because it was so expensive to invest in the market or even reinvest your dividends then. There were no index funds. And today, because of competition and because of technology, the same competition and technology that made Robinhood possible, where you could trade for $0 and you could just have a smartphone in your hand and this intuitive thing that anybody can understand, you could use it to buy an ETF that costs 0.03% a year and just set it and forget it, or have a robo-advisor for a very modest fee manage a bunch of index funds for you. You know, stuff that just was not possible a generation or two ago. And so it's like anything, right? I mean, we have these cell phones with all the world's knowledge in them, and you know, and then teenagers today aren't any better informed than teenagers were 20 years ago or 40 years ago because they're using it to, you know, to get on TikTok and stuff like that.
Yeah,
so
we learned they're not using Facebook. We learned that today.
Well, exactly.
I haven't been for a while, right?
Yeah, I'm sorry I didn't write a book about Facebook. It'd be a very timely interview. Yeah, so there is a bottom line, a long answer to your question. There definitely is hope, and not only is there hope, but what these people were trying to do is a twofer, right? They were trying to stick it to Wall Street and make money. And if you don't like Wall Street for whatever reason, that's a way to stick it to Wall Street. Pay them very little and outperform most investors by being pretty passive. I mean, using the same technology, basically.
Hey, Spencer, I'm wondering about the companies that you write about in the book. GameStop, for example. Shares of GameStop are down 67% from their highs back in June of 2021. What did all this mean for GameStop?
Well, it's funny, for some of the companies involved, they have taken advantage in terms of their own survival.
Yeah, AMC certainly did that, right?
AMC did it, and GameStop did it too, to a lesser extent. GameStop was criticized for when it was at its peak. You know, it got as high as $483 this week a year ago, or last week a year ago, rather. But they didn't sell stock then, whereas AMC did. AMC converted a bunch of debt and then went out and sold overall more than $1 billion worth of equity at very high prices to this new group of shareholders. All the old shareholders just cut and run. They couldn't believe their luck. They cut and run. You know, they're like, this is too rich for us. GameStop as well. It's just index funds that are in these that have to own them that are in there now, as far as institutions go, and then it's just retail. And it was a bonanza for those funds, by the way. And it was just dumb luck for them, and they sold money. So yeah, if you raise a bunch of cash, AMC in particular was in danger of going bankrupt within, some people thought within 6 months, and GameStop was not in good shape either. It helped them, but it helped them at great expense to this enthusiastic new group of shareholders because they bought pretty expensive equity from the company.
So, and I'm sure in talking to your son, and we all talk about talking to a younger generation, that they often feel like the financial markets and the stock market in particular is rigged, and it's skewed for, the big guys to win. Do you agree with that assessment?
To some extent, I do. I don't think it's rigged in the sense that like a casino game is rigged or a carnival game is rigged. But the reason that I have the fleecing of small investors isn't because I'm accusing anybody of a crime. There are allegations of criminal conspiracy, which are just not true in this whole episode. But it's rigged in the sense that you have these companies with big marketing budgets and very slick technology, and then you have consumer advocates with very small budgets and a kind of a difficult argument to make. People like to speculate. You don't, especially young people, don't need much encouragement anyway to speculate. And then you have very slick marketing campaigns. Robinhood, for example, you were born an investor. Oh, and here's a free mystery share of stock, which is like a lottery ticket when you open an account. And if you get a friend to join, then you both get a share of stock. It seems like it costs them a lot of money because people have such small accounts, but it pays back very quickly because those new people get active too. So it's kind of a difficult instinct to fight against. But young people, I understand why they resent Wall Street, because it does seem like there are two sets of rules. And their formative experience was the financial crisis and also being saddled with student loans. And so I think they have a legitimate gripe, and they kind of personified it in these hedge fund managers they were ambushing basically in this whole episode.
Right.
But it's a kind of a quixotic quest, I think, because they didn't really hurt Wall Street. They actually enriched Wall Street.
Well, it's a great conversation to be having at this time, considering everything that's going on and just watching like where we were a year ago and trying to make sense of it. Spencer, thank you so much. Really appreciate it. Spencer Jacob, columnist for the Wall Street Journal, and check out his book because it really does pertain to so much that we've seen over the last year. The revolution that wasn't GameStop, Reddit, and the fleecing of small investors. Our thanks to him. We should recap Facebook one more time.
Yeah, shares continuing to sink, now down just under 22%, 21.5% right now after revenue forecast misses estimates. Fourth quarter user growth fell short of expectations. Earnings per share missed estimates. Revenue did top the analyst figure. The company said that Apple's iOS changes hurt growth, but the story is much bigger than that. We are going to hear from Facebook executives in just a few minutes at 5 p.m. Wall Street time when they start their earnings call, so we'll keep an eye on the stock during that time. But shares getting crushed in after hours, Carol.
Our Naomi Nix on our live blog saying a few important questions to keep in mind ahead of that call. Expect Meta to explain the decline of its user growth on its flagship app. Facebook, as we said, reporting 2.91 billion monthly users in the fourth quarter compared with analyst projections of 2.95 billion. So that was a miss. Also about the investment in Reality Labs. That's its virtual and augmented reality division, and understanding Quest 2 sales, what we get in specifics in terms of those numbers. Meta is reporting $10.19 billion loss in that division for 2021. They will have to defend that big gamble. That is coming from our Naomi Nix.
And finally, Carol, another question posed by Naomi. Investors are probably going to ask about how Meta plans to compete against its younger rivals. We're talking TikTok here. How's Instagram's Reels doing against that? I don't know. I find myself going down holes on Instagram Reels.
I try to put the phone down. Mandeep Singh talking about this, about kind of where other people are going at this point. Facebook isn't that young startup it was anymore, and it's dealing with a lot of other startups. Anyway, stock down about 20% or so in the after hours. Busy day. We'll see how this plays out in the markets. For Tim Stanovic and the Business Week team, have a great evening. This is Bloomberg.